Hey guys, how's it going? If you watched my first video, I broke down a simple and low effort way to set yourself up for financial success. However, if you're a beginner investor, the very idea of investing may seem a little confusing to you. In fact, I've heard a lot of people say that they're scared to invest because they could lose all their money. This video is meant to clear any worries you have about risk while investing. I'll explain exactly how investing works from a technical standpoint in a later video, but today is all about giving you the confidence to start. I'd like you and I to venture a little more into the jungle of investing together. Who knows what could happen? So, I'm a firm believer in investing in S&P 500 index funds. If you want a quick reminder about what the S&P 500 is, specifically an S&P 500 index fund, it's fractions of the top 500 largest company stocks in the US, all clumped together in one ETF. Now I'm gonna have to explain what an ETF is, aren't I? Yeah, I am. Okay, so an ETF is similar to a stock in the sense that you buy it in the same exact way as you would a stock. But if you just buy a stock by itself, you're exposing yourself to a whole lot of something called unsystematic risk. That's a type of risk that only affects a single company. So let's say you invest in Apple, then the Apple CEO appears on the Epstein list or something, and he resigns from the company, and that causes a bunch of internal turmoil inside the company and doubt from the public about the company's future. Okay, that'll obviously tank the Apple stock, but it won't really affect any other company's stock in the process. That's what unsystematic risk is. Risk that only affects a singular company. Risk that could be easily managed with diversification. Systematic risk, or market risk, is like what happened during COVID, or any other big financial crisis. That's risk that can't be managed with diversification. The entire market goes up and down together. Okay, where were we again? Oh, right. Okay, alright, stay with me here. You can buy an ETF in the same way that you buy a stock, but an ETF is basically a whole basket of stocks. You can just buy the one stock and take on a lot of unsystematic risk and systematic risk. Or you can buy the basket full of stocks, which gives you an automatic shield from unsystematic risk. So that's why ETFs are so attractive. Automatic diversification. Okay, going all the way back to my original thought, S&P 500 index funds is an ETF, or a basket, with fractions of the top 500 US companies' stock in it. Oh, and you don't have to worry about it being super expensive either, since it's just fractions of each stock, not the entire thing. If it wasn't fractions and you wanted to buy it, it'd be like a bajillion dollars or something compared to $130 or whatever. Whoa, okay, I'm confused. Hopefully you guys got that. Alright, now to the two people left watching this video, that's why I love S&P 500 index funds. You quite literally have decades of history backing you up, assuring that you'll make consistent good returns year after year. It's a literal set it and forget it strategy. And what could be better than living your day-to-day life while making money in the background? Probably a good burger from Five Guys. But what if you're bored of the S&P 500? What if you want to find ways to make above average returns and beat the market? Let's look for some strategies. The first thing I think of is a little something called arbitrage. Imagine this. You buy Apple stock for $100 from one stock exchange, since that's what this particular exchange has the buy listed as, and you immediately turn and sell it for $100.50 on another exchange, since that's what this exchange has the sell price listed as. Whoa, is this for real? Yeah, you actually can do this. It's a real way to earn risk-free profit. What's the catch? Well, you're competing with computers who catch these arbitrage opportunities and close them in literal fractions of a second. Wow. Way to bring a gun to a knife fight, computers. But how do these computers close the arbitrage opportunity? Why can't you just follow behind them and do the same thing? Well, the market that's selling Apple for $100 sees an increase in demand from these computers doing the trading, which raises the stock price from, say, $100 to $100.25. Then, after these computers buy Apple stock from Exchange 1, and sell it just as fast to exchange 2, this increase in supply lowers the stock price from $100.50 to, say, $100.25 on that market. Boom. Now the prices match and the arbitrage opportunity closes. Ah well. Ah well. Hang on. This helps you though. These super fast computers closing arbitrage opportunities keeps your S&P 500 index fund price efficient, priced fairly, and provides you with a ton of liquidity. Okay, so we can't cheat the system that way. What are some other ways? Well, we could basically gamble by investing in super volatile stocks like Tesla, or investing in penny stocks and hoping that they blow up. Keep in mind, the more risk that an investor is willing to take on, the more the market rewards them, and the greater returns they make. And I'm not just saying that, there's a literal formula that demonstrates it. Okay, so you could buy a penny stock, but there's a very low chance that you see huge profit, or profit at all, from that gamble. If you're a gambling man, then go ahead and try penny stocks. If you're a little more wise with your money, how could you make similar gambles without any risk? Well, imagine there's a moderately big company that still has a ton of potential for gains. The second it becomes within the top 500 stocks in the US, it automatically pushes its way inside the S&P 500 and bumps out the lowest guy. Honestly, it's just like Among Us. Now, the rest of the gains that the company makes are captured in your returns if you hold an S&P 500 ETF. If it ends up flopping, oh well, it gets bumped out and replaced by another company who enters the 500. Big Wall Street investors look at so many complicated algorithms, formulas, and methods for making big returns, taking big risks at times, and using their finance brains to make big smart money moves. Imagine you had every single one of these Wall Street guys working for you. Ah, I wish. You're not gonna believe what I'm about to tell you. You do! They do work for you. Their success is your success, and their failures barely touch you at all. How? S&P 500 index funds. When you invest in an S&P 500 index fund, you're riding on the collective success of the 500 largest public companies, in which Wall Street's best brains are employed to maximize profits. So for the love of God, park your cash in an S&P 500 index fund. Alright, that's the title of the video. Investing is easy, and now you know why. There's only one choice you need to make, and one thing you need to do to become the boss of Wall Street, literally just buying an S&P 500 index fund. So, like I said in my last video, go on Google, type in S&P 500 index fund ticker, pick one that looks nice, make sure it's in your own currency, and throw in your savings. There. That's why investing is easy. No more thought needs to go into it, even though I just explained the ins and outs of why it's the best investment move you can make. All roads lead back to an S&P 500 index fund. So I hope you've learned something today, and I'll see you next time.